All right, welcome to The Explainer. Today, we are diving into a really fascinating real-world financial case study. It's all about a civil servant's pretty unconventional plan to turbocharge his retirement savings and really build some generational wealth. Okay, let's just jump right in. To really get why this strategy is so aggressive, you first have to understand the motivation behind it. This quote, it's from the person at the very center of our story. And you can tell, this isn't just about having a comfortable retirement. This is about a fundamental shift, about changing his family's entire financial destiny. So this all starts with one person, a 48-year-old civil servant in Taiwan. He's not just looking to tweak his portfolio a little bit. No, he's writing to a financial consultant with a huge, ambitious goal, and it all revolves around this 20 million TWD question. Now, he's spent years being disciplined, saving his money, and he's a big believer in the stock market. So he's already cooked up this bold idea for what to do with his savings. But, before pulling the trigger on something this big, he knew he needed an expert to weigh in on two key points. Points that could honestly make or break the entire plan. So what were these two big questions? Well, the first one is all about security. He's asking, do I really need to keep a big pile of cash, 2 million TWD, just sitting on the sidelines, uninvested? And the second question? That's all about timing and cash flow. Essentially, when can I start using my investments to generate an income by borrowing against them? Okay, so before we can even get into the advice he received, we have to understand who we're talking about here. He laid out his financial situation very clearly, and it's super important context for the pretty aggressive strategy that he's proposing. So let's talk about the starting capital. And this is the big one. He's managed to save up an incredible 20 million Taiwanese dollars. That's more than 600,000 US dollars, by the way. And it's all in cash, just waiting to be invested. This is the fuel for the entire engine. Now this is what I find so interesting. You see this contrast, right? On one hand, you have this picture of incredible stability. He's got a secure government job, 3 kids, 0 debt, and a pension coming his way that's going to cover most of his living costs. It's from that rock-solid foundation that he feels he can launch this incredibly bold growth strategy. So, what did the consultant say? Well, he didn't just give a simple yes or no. Instead, he came back with 2 very distinct strategies. He calls them the 433 and the 424 plans, and they're designed to directly answer the client's questions. So the very first thing the consultant does is tackle that emergency fund question head on. And his advice? It's bold. He says, forget about that separate 2 million sitting on the sidelines. Invest all of it, the whole 20 million. The strategy doesn't ignore the need for cash, it just builds it right into the portfolio itself. And here they are, the 2 plans, side by side. At first glance, they look pretty similar, right? They're both using the same 3 basic ingredients, a US tech fund, a leveraged version of that same fund, which basically uses debt to try to magnify the returns, and then a cash-like money market fund for stability. The only thing that changes is the recipe, the percentages. The 433 is spicier, more aggressive, while the 424 pulls back on the risk and adds a bigger safety cushion. All right, let's zoom in on the 433 plan. This is the more aggressive option. You can see right away, 70% of the portfolio is in US tech stocks, and a really significant 30% chunk is in that leveraged fund we talked about. This is a big bet on growth, but it's balanced by that 30% in cash for stability. Now, by contrast, here's the 424 plan, which is the more conservative of the 2. See how that leveraged piece shrinks down to just 20%, and that extra 10% gets moved right over into the cash buffer, bumping it up to a really substantial 40% of the whole portfolio. I mean, it's still an aggressive plan for sure, but it's got a much bigger safety net. Okay, so that handles the investment strategy. But what about that second question, the one about income? How does he actually live off this money? Well, the consultant's plan for generating cash isn't about selling stocks, it's about borrowing against them. And the key to this whole thing is something called a stock pledge. Honestly, the easiest way to think about it is like a home equity loan, but for your investment portfolio. You're using your stocks as collateral to get a cash loan from your brokerage. The beauty is, you get the cash you need without having to sell a single share, which means you avoid things like capital gains taxes. So the natural question is, when should I start doing this? And the consultant's answer was emphatic. Do it now. Don't wait until you retire.
The idea is that by borrowing against the portfolio today, he can supplement his income, and, this is the really crucial part, he can reinvest any money he doesn't spend to make the portfolio grow even faster.
So this isn't a one-time thing. It's a cycle that's designed to be repeated every single year. It's a pretty simple four-step loop, really. You pledge your assets, borrow a fixed amount, in this case 400,000 TWD, you spend whatever you need to, and then, and this is the accelerator, you take whatever is left over and you plow it right back into the market. It creates this really powerful compounding effect. All right, let's step back for a second. If you boil this whole complex strategy down, what are the core ideas, the key principles that really make it tick and make it so different from what you usually hear? So when you put all these pieces together, you start to see the big picture. The entire philosophy is to make every single dollar you have work for you all the time. So instead of having a lazy emergency fund sitting in a savings account, you have a large cash position inside your portfolio that acts as your safety net. And instead of selling off your assets to live, you borrow against them, which lets your investments keep growing and compounding while you get the cash flow you need. And that really brings us to the final question, doesn't it? This whole plan just completely challenges the traditional way of thinking about retirement. It blurs the lines between your savings, your emergency fund, and your income. So you have to ask yourself, is this a truly innovative, maybe even revolutionary model for building wealth? Or is it just a massive, high-stakes gamble that's betting everything on the market always going up? Now, of course, we have to end on this note. This has been a fascinating breakdown of a case study, but please remember, this is for educational purposes only. This is not investment advice. It's a very aggressive strategy. It comes with significant risks, and any investment decision you make should only come after you've done your own careful research.